Hi there, welcome to Kneppy Invest. Now in this video, I'm going to be talking about why technology stocks are crashing right now. So if you're a holder of a few technology stocks in your portfolio, or if your portfolio is full of tech stocks, you ought to be noticing those tech stocks are really underperforming the overall market. In fact, if you've been holding, say, bank stocks or even energy stocks, you're actually overperforming the market at this point in time. So what is happening? Tech stocks over the past 10 years have outperformed the market. Why has it all of a sudden just switched over the past few months? So in this video, I'm going to be talking about why this is happening. I won't be saying if this is going to continue, but the main thing is deciphering what the hell is happening with tech stocks right now. Now, to begin with, I'm going to just go through a few examples on the NASDAQ and on the Australian markets and see what's happening with individual companies in the tech sector. I'm going to begin with the company called Firm. This is a recent IPO on the NASDAQ. They are a buy now, pay later player. And this sort of company is going to be the sort of company that's going to be most affected by what's happening in the overall tech sector. Their share price has gone down 50% since their high on the 10th of February, which was 147. And the most recent share price on the 8th of March was $74. Next, I'm going to talk about Snowflake, one of my favorite companies simply because of their name. This is another not profitable company, and it's one of the most successful IPOs we did see in 2020, and we even saw Warren Buffett's Berkshire Hathaway get involved in this IPO. The share price was as high as $429 on the 8th of December, and ever since then the share price has fallen 50%, and at the end of close of trading on the 8th of March, the share price was down to $214. Next, we have Mercado Libre. This is actually one of my favorite companies because I think they're expanding quite rapidly, and they've been affected by this tech sec runoff as well. Their share price is down 32% since the share price reached a high on the 21st of January at $2,020, and at close of trading on the 8th of March, they were $1,369. Potentially, this is a buy the dip scenario. And next we talk about everyone's favorite company, Tesla. Now, even Tesla's been affected, even though in my opinion, just my opinion, it's not a tech company, it's a car manufacturing company. And I think a lot of people would disagree with me that. I think even the market disagrees because this company has been significantly affected by this tech sell-off. Share price down 37% since it reached a high of $900 on the 25th of January, and the most recent share price was $563. Share price has been falling right like a rock, and if I was a shareholder of Tesla right now, I would be a little bit concerned, although I'm pretty sure those buy the dips investors will be licking their lips right now. And even Apple has been affected. Share price down 20% since the 25th of January. Very similar date to Tesla's high, if you remember that. The high was $145, and now you can buy it at $116. So maybe, again, this is a buy the dip scenario. So will those buy the dips investors really take advantage of this dip in the share price? Now to the ASX, and even ASX stocks have been affected, but I'm really going to focus on buy now, pay later, because they are really suffering over the past 2 weeks. And the first one is Afterpay. Share price got as high as $160 on the 11th of February, and the share price has been dropping like a rock on a high gravity planet ever since, down 33%. And the most recent share price at the close of trading on March 9 was $107. Is this another buy the dip sort of scenario? Well, when you look at the trend here, it's looking quite weak, the share price action, but I'll leave that up to you whether you do buy the dip here. And finally, we get to look at Zip. So this is another buy now, pay later, another not profitable company that's been really affected by this tech sell-off. Share price down 40% since the high that was reached on the 16th of February at $14.53. Most recent share price is $8.72. When is the dropping share price going to stop? And finally, I just want to talk about ARK Invest Innovation ETF. And this has been one of the best performing ETFs you could find anywhere in the world over the past year or so. Kathy Wood has done a phenomenal job with this ETF, but you can see even ARK Invest has been significantly affected by this tech sell-off. Share price has gone down 31% in 3 weeks from a high of $159.70 to a share price of $110.26. For those who are really interested in this ETF, maybe this is another buy the dip. Who knows? So the first thing I always do when I wake up from my slumber overnight is to check the US markets to see how they've performed. So when I did that this morning, the thing that really popped out to me was how the Dow Jones significantly outperformed the NASDAQ overnight. So the Dow Jones was up 1% and the NASDAQ was down minus 2.4%. Now this sort of thing we've seen quite a few times over the past few months where the Dow Jones has been up and the NASDAQ has been down. Vice versa, actually, we've seen it a few times as well, where the NASDAQ has been up and the Dow Jones has been down. But over the past 6 months or so, and I've got a table here looking at the comparisons between the performance of the NASDAQ compared to the S&P 500 and the Dow Jones. You can see the NASDAQ has significantly underperformed the Dow Jones over the past 6 months. But when you look at the 1 year time frame, the NASDAQ has outperformed the Dow Jones. So why is the NASDAQ right now underperforming the Dow Jones? There is a reason behind it, and I'll get into that reason in a few slides. So here I've got just a 10-year bond yield going back to the early 1980s. So this is almost 50 years of data here. And the first thing that pops out is that the trend in the bond yields over these last 50 years has been down. And that's very important to what we've been experiencing in the last few months. So what I've done in this slide is just zoom in the 10-year bond yield to a shorter time frame, looking from the May 2018 to present time. So when you look at the longer term, the 50-year time frame for 10-year bond yields, you do get a long-term downtrend. But when you zoom in, you can see shorter-term trends in there, and we definitely see that in this chart here. So in 2018, and if you remember back to 2018, it was the worst year in a decade for the US indices. They were all down between 4 and 6% for the year. And what happened with the 10-year bond yields in that year? They were going up. And then what happened from 2019? You can see in 2019, which I show you that in that arrow, you can see that the 10-year bond yields were going down. The NASDAQ was up 32% and the S&P was up 29%. The other little line there I've got there, that brown line that's sloping downwards from the top left to the bottom right, that is the short-term bond yield trend, and that broke at the end of 2020. That's very important to note in this chart. So in this slide, I've zoomed in even further and looking at the last 15 months in the 10-year bond yield. And there's two things I've gleaned out of this slide. In particular, we have a well-defined uptrend in the bond yields that has been ongoing since August 2020. This is a perfect looking uptrend. And the second thing I can see from this is an acceleration in the bond yields in the past month and a half. And you can see that with the gap developing between the bond yields and the uptrend. And right now, the bond yields have reached a point they were before the onset of COVID-19, way back at the start of last year. So in my opinion, rising 10-year bond yields are the reason behind the current weakness in techs. If you disagree with me, I'd love to read your comments, but this is only my opinion. There could be some other underlying opinions, but I think there is a good correlation between the rising bond yields and the current sell-off in techs. Now, I'm just going to go through why rising 10-year bond yields are the #1 NEP for tech stocks right now. And it all comes back to the discounted cash flow model. So if you don't know anything about this, I do recommend maybe reading up, going to some YouTube videos and looking at those. I'm not a big believer in a discounted cash flow model. I don't use it personally, but it does give us some sort of glimpse into why the tech sec is selling off right now with rising 10-year bond yields. So the discounted cash flow model is at the heart of this issue, in my opinion. And the way to look at this is the value of an equity or a stock is simply the present value of its expected stream of cash flows. So the way you look at it is if you buy Afterpay right now, there's two reasons why you might be buying Afterpay right now. You believe there's going to be some sucker or some investor in the future who's going to buy that at a higher price, or you believe the company is going to return to you some sort of dividend or something in the future that's going to be significantly higher than it is now, which is zero. So you do expect some return from the company in the future. And that's very important now, that you're expecting some sort of return from the company in the future. So the present value of cash flows is dependent on the discount rate, which is the opportunity cost of owning alternative assets, or the interest rate. So a really good way to look at that is, or look at this, is comparing what you could earn if you owned a stock compared to just putting your money in cash. So if you were earning, say, 5% in interest rate for just having cash, and maybe you could earn 4% by owning a stock, why would you own a higher risk asset like stocks at 4% when you can put your money into cash and earn 5%, which is almost risk-free? So it all boils down to this. The higher the interest rates, the lower the present value of future cash flows. And that's a very important point to try to understand if you're an investor, not only right now, but forever. So how does that relate to tech stocks? Why is tech stocks falling? Well, the longer in the future a company's cash flows are expected, the more the company will be affected by rising bond yields. And just take a buy now, pay later company. So they're not profitable right now. So we don't know how long they're going to be profitable. It could be 5-10 years down the line. So those future cash flows expected are further into the future. So those present value of those future cash flows should be discounted further if interest rates are rising or expected interest rates are rising. So if we're expecting Afterpay in 10 years to have or become profitable, if those 10-year bond yields are rising, those future cash flows for Afterpay have to be valued much less today. And that is why NASDAQ is falling right now and Dow Jones is rising. And that is why tech stocks are falling and non-tech stocks, bank stocks, energy stocks are rising, because in tech stocks, most of the future cash flows are well into the future, particularly those non-profitable ones. So I just went online to find a DCF calculator to compare different discount rates. So I just compared 2% to 5%, leaving everything else the same. So I used earnings per share of $1, earnings expected to grow at 10% annually for the next 5 years, then growing 1% thereafter. And the only difference between these two models is the discount rate of 2% compared to 5%, and you got a stock value per share coming out. So with a discount rate or interest rate of 2%, you have a stock value per share of $153.63. When that increases to 5% interest rates, stock value has gone all the way down to $37.62. That is, in a nutshell, why tech stocks are being sold off right now. So that's all I've got on this video. Why, in my opinion, technology stocks are crashing. Now, I'm a big fan, or still a big fan, of tech stocks moving forward, but I do believe there is some scope for some correction in their share price because they are overvalued by quite an extent. But moving forward, if they do run down, the share prices run down even further from here, I believe there will be some opportunities to buy in some very attractive companies moving forward. So be on the lookout for that. Also, try to understand the correlation or the importance between the relationship of bond yields, particularly the 10-year bond yield, and asset prices. 10-year bond yields are the proxy to pricing assets. So keep in mind that if you want to do some more research on that, I might do even a few more videos on that very subject. I'm not a financial advisor, so if you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's all for this video. Have a good day. Bye.